Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
That's a question of, he says, in a dollar bull market, how do you feel that the platinum group metals will fare?
We see it two ways. In the beginning, throughout the first half, and again, this is our crystal ball. We're gazing into our crystal ball here and guessing, but we see the gold doing badly in the first part of the year. The metals and gold from the more industrial metals, I think it's a different story. And again, we don't focus that much on the industrial metals. But gold, we think, is going to have some competition on rates because we think you're going to see rates increase across from the Asia central banks early on in the year. We think the U.S., if it doesn't hike, you're going to see the yields push up anyway just from the market. So we think gold's going to get some competition, and we think you're going to see it fall relative to the dollar that in play. But towards the end of the year, we happen to think we're going to get back into a pretty nasty deflationary situation because of these breakdowns that we think can happen if the China bubble pops. We think gold actually can act well in that environment and can take some of that role as a safe haven and actually do well in the deflationary environment because rates are going to come down and you're not going to have that competition. There are going to be some people that just don't want to put money into the U.S. or into the dollar, and we think gold can play that role towards the second half of the year. That's our guess.
So, Jack, I guess you're a believer in deleveraging and it's not done yet.
Absolutely not.
So my second part of the question would be, if that's the case, are you looking, if you were to pick two or three currencies that you really don't like at all, maybe I'm going to guess a couple. One would be the Australian, one might be the New Zealand, and maybe the euro. I mean, I guess it's two different things, commodities versus the European currency.
Yeah,
but
different time frames. The euro's number one, of course. Hungarian forint we think is going to get destroyed.
Okay.
We think Australia. We think the commodity currencies, if we get the continued growth and healing, so to speak, in the first half of the year, we'll do fine. But once China gets in trouble, and you see it today, even a hint of it, if those China bubbles start to break, we want to just be short the commodity currencies all the way down. They're going to come down a ton, because commodities will break, and already as that chart I showed you, you see the huge extension of the Australian dollar relative to its fundamentals, which really are commodities. So that's our, that's one we would be on, and other minor currencies like South African rand we think would get destroyed too in that type of environment. Japanese yen, we think that if we get the yen is acting a little bit well in risk in here, but if we get some growth in here and we see interest rates start to go up, the Bank of Japan is not going to budge. We think the Japanese yen in the first half of the year or in the next several months will start to weaken. Again, if there's not a major risk event going on right now, but if we get through this, we think the yen will start to weaken and take over the carry trade currency for a while. But again, once China breaks, we think the yen will do okay. So we don't like the yen. Once we get through this period in here, which we think is a near-term move, we think the yen could weaken. We think the yen is very overdone.
Jack, what theme would make you wrong? I mean, I know that you think about this all the time.
Yep.
What would make you wrong? And Jones says, do you think the dollar will fall in the short term because of ample liquidity still available? So then I just paraphrase this question. Would it be that more good news out of China? Would that be it? Or some better news out of Europe would make the dollar a bit weaker? Or is it just terrible news here in the States?
Well, we told you we watched the front end of the curve, the Fed funds and the LIBOR, and we watched the 2 years. We watched that very closely. It's very clear what's going to make us wrong is if we don't see If we see continued slight rebound in the global economy, as you said, China's still doing well, and we think they can do well because the liquidity is still flowing, and there's a lot of money flowing to China expecting a one-off revaluation that we don't think is going to happen, but that's a lot of liquidity that they're getting externally that they don't have to generate internally at the moment, and so we think the power of that will continue them going for a while. But if the U.S. doesn't show some growth, if jobs don't improve, if we don't start to rebound and China continues to do well, and we don't see an uptick in interest rates, and the Fed comes out and just says, we are not budging forever, we're going to stay here, and the dollar is going to be the implicit carry currency, we're going to use it to continue to fund the world and keep the world afloat, and that would be clear signal from the Fed, then we're wrong. And obviously, if forgetting the economic fundamentals, if the dollar comes down and breaks a new low between 70, we're wrong. So there's a technical level we're wrong. And the reason we like this trade is because if we're right, the potential upside could be huge. I mean, the last dollar bull market went like 50, was up 50, 60% from the bottom. The one before that, it was over 100% move. We know where we're wrong, and it's not that far, 6, 7, 8%. But if we're right, the upside, we're looking, this is a, 5, 10-time potential winner. So we like those types of setups. But it's a good question because we always think about where we're wrong, no matter what trade it is. Whether it's this big macro trade, we have a reason why we're wrong, or whether it's a shorter term, 2-3 weekly trade that we, 2-day or weekly trade, we look at things and ask ourselves, where are we wrong? And I think that's a great question that they ask us, Steve. You know this. Often, I think if you've been in this long enough, the first decision you make before you put a trade on should be, how much risk can I take in this trade, and then think of your upside. Where most people that are new to trading think of the upside, don't think of the risk. Soros said this early on in some of his writings. He said, all traders should be a lot paranoid, meaning every time they put on a trade, all they should be thinking about is where they're wrong. They should not be looking for information that validates why they're right. They should only and constantly be looking for information why they're wrong, and I think that keeps you out of trouble.
Well, it surely kept me out of trouble all my years as a trader. But it does drive you crazy, but I guess it does help you, Jack. So I would second that point.
Yeah, it helps psychologically, because if you're open to the reasons why you're wrong, you're going to see them. Psychologically, if you're trying to look for information to validate why you're right, you're going to miss the negative information coming in, and you just won't see it, and then you'll get blindsided. So there's some real psychological reasoning why you should, think that way.
Yeah, that makes sense.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.